Commercial real estate investing means buying and managing properties for business purposes. You generate income by leasing space to businesses. Common property types include office buildings, retail centers, warehouses, industrial facilities, and apartment complexes with 5 or more units. Your returns come from rental income and property appreciation. Commercial leases typically run 3 to 10 years, giving you stable, predictable income. Hard money loans are short-term financing options secured by commercial real estate. Private lenders or investment groups provide these loans for quick capital access. Approval depends on property value and income potential rather than your credit history. These loans typically cover 65 to 75% of the property value. Interest rates are higher than traditional loans, ranging from 8 to 15% per year. They're perfect for quick funding of distressed properties, auctions, or value-add projects. Loan terms usually last 6 to 24 months. You'll pay upfront points of 2 to 5% at closing, make interest-only monthly payments, and face a large balloon payment when the term ends. Hard money financing offers real flexibility when traditional loans can't meet your timing needs. Lenders focus on the investment strength rather than your financial history. These loans work well for properties needing major renovations or suffering from low occupancy. You can close in 7 to 14 days, giving you a stronger negotiating position and reducing competition from investors who can't secure fast financing. When structuring deals, you'll need a 20 to 30% down payment. Calculate your net operating income after renovations and assess capitalization rates. Your total acquisition cost plus improvement budget must stay below the stabilized property value. For exits, you can refinance for better terms or sell for profit. A 1031 exchange can help you avoid capital gains taxes. Hard money loans carry risks. Higher costs and shorter repayment periods demand solid exit strategies. Your expected profits must exceed the high financing costs, including interest charges and origination fees. Compare expenses against projected rental income or resale profits. Build in contingency plans for market changes and delays. Research reputable lenders and network with real estate professionals for recommendations.